welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. The end of the financial year is upon us, and like every year, I'm very sure a few of us would still not have done our investments properly, perhaps don't even have our documentation right, and would be running helter-skelter to make sure that they've got all the bases covered, whether it comes to tax planning or investments or just getting basic paperwork in order. Well, worry not, because Money, Money, Money is here to handhold you and help you get through this process. And joining in to do that and help us all out today is financial planning expert Harsh Rungta. Thank you, sir, very much for joining in. And I know it's like, like the teachers would always say, right? Why are you waiting to the last moment to study for the exam? You had the whole year to prepare. So is it something like that when it comes to this topic?
Oh, it's absolutely something like that, because typically, if in the middle of March, you are worrying at investments, effectively, you're not really worrying about investments, you're worrying about tax. Okay. And tax cannot be the reason that drives investments. Okay. I mean, your investments, your insurances, everything needs to be driven by your needs, the risks that you face, and the goals that you have.
True.
And if it is driven, the only thing that tax does is it reduces the cost of insurance. It increases the returns from an investment, right? So to that much extent, it must be used.
Yes.
But chances are that if you have waited till now and you do things in a hurry, you will be one among this legion of people who go out and buy the next money back and endowment policy that is offered by a eager little insurance agent close to you.
I understand. I must admit, and candid on camera, national television admission, that not now, but many years ago, much before Money, Money, Money happened, there was this last minute investment. We all do it. Quick lump sum had to go in because it's sort of the, the 30th of March or the 29th of March, and you want to at least cover your bases with respect to Section 80C. Now, I completely take what you're saying on board, and yes, we need to be far more prudent. But before we get to that aspect of sort of proper goal and financial sort of planning, let's help out people who are in need at the moment. So if you could just revisit and sort of tell us the options, what are the common sections that people tend to overlook or forget or not sort of cover properly in order to take care of the tax burden.
So first of all, on the more popular Section 80C itself, I think you need to do a quick check on whether you have already taken advantage. So typically, most people would have looked at their provident fund. If they're paying any insurance premiums, they would have looked at it. If they're paying any home loan installment, then the principal portion of the home loan installment comes under Section 80C.
So chances are you've anyway covered your 1.5 lakh limit,
maybe,
especially if you have a home loan.
Fourth, which they might have not considered, is the tuition fee paid for children. Now, that's also allowed to be deducted under Section 80C. So, I think, first of all, find out if there is a gap.
Sure.
And then the problem is, or what shall I say, the investment that you need to do is only for that gap.
Correct, correct.
If you're doing it last minute, I would not advise equity. No matter how risk taker, how big a risk taker you are. I think unless the amount is like 5,000, 10,000 rupees, which is another matter. But if the amount is larger, I think an instrument like a national savings certificate, or maybe even a 5-year bank FD, maybe those are better instruments, simply because doing lump sum into equity is never advisable. And the biggest thing, of course, that you should do is what we spoke earlier. Never again will you ever be in this situation.
That you have to take a hasty decision with your back up against the wall as the clock is ticking just because you have to save on tax.
So the other thing that you could possibly do is that if you're not covered for health insurance,
correct,
or you have not covered your parents for health insurance, and that is a risk that you face.
Sure.
Then I think you can look at increasing the risk cover or taking that risk cover for your parents. Also consider if you've taken any education loan, etc., for either for yourself or for your children.
Okay, so I'm going to quickly recap the sections. So just make sure, go through the checklist and make sure that you've covered. In case you have any expenses under these heads, then maybe you can sort of look at, the tax relief there. So ATC, that's 1.5 lakh rupees. Then there is health insurance, which is 80D, which is, I believe it's still 25,000 for self and spouse. And
if you are not a senior citizen.
If you're not a senior citizen. For senior citizens, by the way, it went up this year itself. The limit is 50,000 rupees for senior citizens, correct? And for senior
so
citizens,
I think that would be applicable from next year.
From the following financial year. Okay, fair enough. And for senior citizen parents as well. The limit stands at, I think, 30,000 rupees. Right. So make sure that you've at least taken the health policies. The education loan, what is the tax break that you get on it?
The interest that you pay on a loan taken for the higher education of yourself, your spouse or your children, that is allowed to be deducted without any limit.
Okay, but there are no caps on a yearly basis or annual basis. The entire interest paid out in a year can be set off against.
There are certain conditions. I'm not,
we're not getting into details at the moment, but that interest can be waived off. Any other sections?
It has to be from a bank or a financial institution or a charitable institution, etc.
Okay.
So there are, and it has to be during the first 7 years, and so there are certain conditions surrounding it.
Okay, fair enough. Now,
if you're doing any charity, and you haven't done it. So charity at least you can do one time. Okay, so that is a deduction that you can get under section.
And that's also
80G.
The entire amount, which is
50%, typically, unless you are doing it in funds which are typically the Prime Minister's Relief Fund, etc. Unless you plan to do it in those kind of funds, the deduction is 50%.
Okay, all right, fair enough. This is the tax planning special. The financial year is drawing to a close and we are here to offer a quick checklist if you have been one of those latecomers who hasn't yet managed to sort out your investments and your taxes. So we've already sort of enlisted some of the major heads, Mr. Rungta. ATC, then health insurance, 80D, in case it's an educational loan. Just make sure that you take the tax advantage under all of these sections. There's also NPS, the National Pension Scheme, and a lot of planners that I speak to, investment advisors I speak to, largely are positive on this scheme. A, because of the additional tax advantage, it's 50,000 extra, and B, that it lets you invest in equity, and now there's more tax flexibility even when you're withdrawing that money out. What is first of all, your own assessment of the NPS?
So I think NPS, to the extent you get an exclusive tax break that you will not get by investing anywhere else, I think makes lot of sense.
Okay.
Because it's, by definition, it's long term. Okay, you cannot withdraw early. If you withdraw early, 80% you still have to convert into an annuity unless it is one of those three reasons. So clearly you cannot withdraw. There is a physical restraint for you to withdraw early. So it tends to be there for long term.
True.
The tax benefit, the exclusive tax benefit tends to bump up the return. So at least to the extent of exclusive tax benefit, which is if you're salaried, then up to 10% of your basic plus DA, that your employer can contribute in addition to the provident fund or anything else. Obviously, I think he will include it in your CTC. So you will let go of the salary to that much extent, but it goes tax-free or tax deductible into a NPS on your own.
That becomes a dual tax advantage, because what you are investing will also fetch you the tax benefit.
So what you invest will get you a 50,000 rupee exclusive benefit. Assume you have already used up the 150
under ATC.
Under ATC, then an additional 50,000 you will be able to get purely for NPS.
Right.
So I think to that much extent, 10% of your basic plus DA if your employer is willing to contribute, and 50,000 from your side.
Which is also good, because considering what you said, that if that is how your salary gets structured and if your employer is willing to go that extra mile, then that is 10% of your basic plus your DA, which also becomes tax exempt because it's going in this long-term retirement investment.
It's tax deferred.
Tax deferred.
Yeah.
Because at the time of withdrawal,
you
there
will
would be
have to
tax
pay
on annuity.
tax,
There would be some taxation perhaps at the time of withdrawal. So as an instrument, this perhaps makes sense. And even if the employer is not contributing, as an individual, I can still contribute
up to 50,000. So I'm not
up to 50,000 is with the tax benefit. Over and above that, I can contribute, but I don't get the tax benefit.
So if you don't get the tax benefit, I'm not a supporter of NPS, because although it may be a low-cost mutual fund, it comes hedged in with far too many conditions.
The lock-in.
The lock-in. Why would I take that lock-in? And if I put the money in what they call scheme 2 or scheme B, I'm not sure, which has no lock-in, which is like a regular mutual fund, then it is just a low-cost mutual fund.
Then you don't get the 50,000
you don't get, so why would I do that in NPS with no track record of the fund managers? I would much rather do an ETF or a a low-cost index fund in a mutual fund, which is far better regulated. There is a lot of attention paid to it, and which does not come with so much baggage. So I think NPS, to the extent of the exclusive tax benefit, makes dramatic sense. Above that, it doesn't make sense.
All right, fair enough. So at least think about it. If you've not invested, you do have that window, and you do have additional tax to save as well, to the tune of 50,000 rupees in a year. So these are all the options. Now let's talk about the paperwork and the nitty-gritties. And let's take sort of both things in account. First of all, if there's excess tax that's been deducted simply because I didn't show my investments or I'm making late investments, then how is that adjusted? How will I claim for a refund? When will that money come back to me?
So typically you need to file a return anyways, whether exact tax has been deducted or excess tax has been deducted. You would need to file a return. And when you file a return, if excess tax has been deducted, you would claim a refund. Today, typically, if the refund amount is not very large, I mean, I think if it does not run into 5 figures, if it is less than a lakh, you should typically get it in 2-3 months. I mean, our finance minister has promised within 24 hours, but that I suspect is utopia and more of an election promise than reality. But in actual practice also, if your refund is low, it comes within 3, 4, 5 months. It comes, and nowadays it comes automatically credited to your account. So, I mean, that process has eased somewhat. But if your refund is higher than, say, a lakh or so, then of course.
So, one more question on this point. If you've obviously not submitted proofs, or let's say you forgot to send, submit your rent receipts, etc., with your employer, or proof of some policy that you had, etc. And anyway, the final salary calculation has already been done, tax has been deducted at source. Then the additional proofs have to be shown at the time of filing of return. Then do you have to do it through your CA? How does that process really play out?
So now the way that you file returns is there is nothing you can enclose with the returns.
Exactly.
So you just make a claim. As long as you have the backup papers with you. You may not have shown it to your employer. Make sure you have it with you. Make that claim. If your return gets opened for scrutiny, they will ask you for those papers. Otherwise, they will accept your claim on face value and give you the refund. 95 or 98, 99% of the times, as I said, provided the refund is small, it will come automatically.
Fair enough. Anything else that one needs to keep in mind from a tax perspective as the year is closing out?
So I think there are things that you need to do before the year ends. As I said, if you want to claim for charity, make sure you actually pay that out. Some of the deductions are on payment basis, so you're not on accrual basis. So I mean, in the sense that the home loan installment, the principal portion is on payment basis. Interest, whether you have paid or not, you will still get a deduction. But the principal portion you better have paid for you to be able to get a deduction. That is interest, even if it is payable, you have still not paid, you will still get a deduction.
And that's the 2 lakh rupee
that is the 2 lakh rupee deduction for self-occupied property.
For self-occupied property on
So so those are some of the things that you could do. If you have a large item, something like a capital gains, etc., decide what you're going to do about it.
That's a great point that you raised, because can something be done now if you just have sort of 15 days to go, or how do the timelines work? If you've sold off, let's say, a property, then in order to reinvest the proceeds to avoid tax, what are the timelines involved?
So there are two ways in which you can claim exemption should you want to. Okay, so on a property, one is that you can invest up to 50 lakhs in what are called capital gain bond schemes.
Correct. REC and I think
REC
NHAI.
and NHA.
Yeah.
So that you can invest in, but that has to be done within 6 months of the transfer.
Okay.
So if you have, say for example, if the actual transfer has happened by after 30th September, okay, then you have to do it within 6 months of whatever that date is.
And the cap would be
50 lakhs.
50 lakhs
per year.
Per year.
Right.
Okay.
So that is one. If you want to invest in another house, and I would not recommend investing in another house just to save on cap gains. But if at all you really want to invest in another house, then 31st March is not a deadline really. Okay. Then the deadline is your return filing date. By that time, you either invest in a house or you invest that money, okay, the capital gain money or the sales proceeds. If it is a residential property, the capital gain money. If it is property other than residential property, then the entire sales proceeds. You have to invest in what is called a cap gain account scheme run with various nationalized banks in the country.
All right, so these are things to be kept in mind. Speaking of capital gains, I think this will also be the first year where the long-term capital gains tax for equities really kicks in. Any advice here? I don't know how many people would be, liable to pay this tax because the market didn't show too much of gain. But otherwise, I mean, what have you been telling clients? If they cross that threshold of 1 lakh in a year, then what is to be done? How does it sort of, how does it even out?
So if it is today, there is no exemption that they can get except adjusting it against long-term loss, if they have any. Otherwise, if the long-term gains on equity crosses 1 lakh, then you have to pay the 10% plus tax. And you ought to have paid it in installments depending on when the capital, so you would have to pay interest for deferring payment of advance tax as well. So do those calculations and make sure you pay so that you don't unnecessarily pay advance tax, unnecessarily pay interest in the future.
All right, fair enough. I think that's helpful advice and points to keep in mind as the financial year closes. We have been helping you get your taxes in order, get your paperwork in order as the financial year draws to a close. And Mr. Rungta, I completely take your point that this should not be left for the 11th hour at the last minute. So, I mean, what advice would you give to people if, this year has been a bit of a muddle? We're also approaching a brand new year. It's always a good time to start afresh. What would the advice be?
So I think, as far as financial planning is concerned, it is one of those very important things which are not urgent. Okay, so I think you need strategies to convert it into urgent. Okay, and if you take an analogy, I mean, all of us typically pass these New Year resolutions that I will lose weight and I will go to the gym, etc. And one way is that psychologists have found that you can actually convert these resolutions into action is to make a commitment that will result in some kind of a loss if you don't follow through on your resolution. So they would suggest pay a 1-year fee to the gym, right? Now if you don't go to the gym, you would suffer some loss. So the probability that you will do the desired action improves. I would say people something similar on financial planning. Okay. Approach a planner and typically they charge an upfront fee, pay that fee. Okay. One is he would advise you on what to do for the 15 days, okay, which is among the things that we discussed. But more importantly, you can go back to him after the din has died down. Okay. And make sure that in the new year, you don't commit the same errors that you had committed this year.
Absolutely, I take your point. On the subject of getting advice itself, what are your thoughts? Because you know, there are a lot of people offering advice these days. You'll go to, you know, banks and they'll want to tell you they can plan taxes and they can give you some advice with products as well. Sometimes your CA starts doubling up as an advisor. Sometimes your advisor starts doubling up as a CA. So it does get a little hazy. Then there are mutual fund distributors and, you know, they also seem to claim they have your interest in mind. So just demystify this entire universe for us. And the basic question, whom do I get advice from?
So I think basically in India, although there are regulations, SEBI regulates who can charge fees for investment advice, and they are all governed by the SEBI Investment Advisor Regulations 2013. Unfortunately, I don't think it covers people calling themselves as investment advisor. It's only if I charge money for investment advice that I am covered by the regulation.
Sure.
I need not be registered with SEBI to call myself a financial advisor, wealth advisor. You know, there are various nomenclatures. In one of the notes that SEBI has come out with, they have said that except registered people, other people cannot call themselves any of these things.
Sure.
But that besides the point, assuming the regulations stay the way it is, I think one of the things that you must know is that whosoever is advising you, how is he making money?
Sure, sure.
And I think that should be, take that interest, make sure that it is transparent to you. In fact, most regulations require that if he is making any money from the from the producer of the product that is coming to you, that has to be disclosed. For example, a mutual fund distributor has to disclose compulsorily whether the client asks or not, how much commission he is making from the mutual fund house. An insurance agent has to disclose on demand from the client how much commission he is making. I think make those demands. There's nothing wrong with any of these advisors as long as you know how he is making money. And if there is a conflict of interest, you should keep that in mind when you evaluate his advice.
Sure.
My, of course, preference, because that's what I am, I'm a fee-only advisor. So I charge a fee to the client.
Yes.
And that's the only fee that I make. So I would say that is the best way, but that's of course self-promotion. But I think whatever route you choose, it should be transparent.
Absolutely.
I think
at least ask the question, who is paying money to the person who's giving you advice? Is it you? Is it someone else? Is it someone who's manufactured that product? Those are, I think, important things to keep in mind. Last but not the least, for those who insist on doing it themselves, do it yourself, what is the immediate checklist you would give to them as the year opens out, or the first few things that they must keep in mind as they make this promise to themselves of being disciplined and having a clear approach to things?
You should keep things simple. If you want to do it yourself, I think the best thing that you need to do is to be disciplined. So set aside what you invest first, spend later. So if you have 100 rupees, first carve out what you're going to invest.
Sure.
Whether it is 20, 30, 40, whatever it is that you can invest in, do that first. Make sure it goes out automatically into investments. And only what is left you spend.
Okay, fair enough. So I think those are words that we must keep in mind as a new financial year dawns upon us in just the next couple of days as well. Thank you very much to Mr. Rungta for taking out the time and helping us negotiate some of these issues. That's it on this week's edition of Money, Money, Money. Thank you for watching. Your feedback, comments, queries, welcome as always. We'll see you again next week.